Hey guys, welcome back to another video. So in today's video, I'm going to show you a strategy which you will ever need, and that strategy will help you to make a lots of profits. So without wasting time, let's get started. So now this is the strategy which I use, and it's only based on liquidity, okay? And I teach this strategy everywhere and I tell about this strategy. And the thing which I'm trying to say is that this strategy is based on the liquidity, and the liquidity is nothing but the stop losses. Okay, so if you think about that, so what I do is I place my limits where people place their stop losses. Okay, so for example, if somebody is placing their sell limit somewhere, when they see a sell side breakout, I will place my buy limit right over there. Okay, and I will look for one confirmation which is bias, and that's it, and I will just try to place the stop loss opposite of the bias. Oh, I will just try to put my limits which is opposite of the bias. So if bias is bullish, I will place buy limits below of the demand zones or support. Okay, so and what do I mean by that? So here is the example. So this is the example which I was talking about. So if you look at it over here closely, okay, price was doing a consolidation thing, okay, and it was creating a some sort of trend line. If you guys can see that, I cannot mark it because this is a screenshot, I guess. Yes, this is a screenshot. So it's creating a some sort of trend line from here. Okay, so what's our strategy is that whenever you see this type of relative equal lows, okay, whenever you see a relative equal lows like this, the thing which you should do, you should just place your buy limit below of little bit below of that support. Okay, because this line is like a support. Okay, because price gave a fluctuation from here once, so now price can give another fluctuation as per to retail traders, because they think like it has given a fluctuation from here, from here, from here, so it can give another fluctuation from here. But the thing which happened is totally opposite. What will happen is it give a breakout, it take the stop losses. Okay, so when they saw this type of candle over here, what they will do is they will just try to take a sell over here when they will see these type of big candles, and they will see a breakout like here. But we know that this is nothing but a liquidity grab, because you can see that the body of the candle closed inside of this line. Okay, so the price went down, we will place our buy limit and we will just place our stop loss like 10 pips or 15 pips, and our target will be next liquidity pool. Okay, so this was the liquidity pool over here, and it was a fake trend line breakout also. Okay, so we knew that price is respecting some sort of trend line, because we are assuming that there is a trend line over here. Okay, so we can see that there is a trend line over here and price is giving a fluctuation from it. Okay, so now we know that there will be a false breakout of a trend line. Okay, so now price goes down, then it goes up from here, and it gave us like 1:3, and we will just target 1:2 or 1:3 with this strategy. And this strategy is so simple. Okay, and because we need something simple, because trading is already complicated, and now there are some traders, those who want to wait for fair value gap. Okay, that's not bad. If you want a confirmation, you can go for confirmation. You can go for, like, after when you see that the price has taken the liquidity, you can wait for fair value gap, because over here there was no fair value gap. Okay, you can wait for the order block, which was over here. It is like this candle is the order block, you could have entered right over here. But what happens sometimes, that price goes up, okay, and now people think that there is a fair value gap right over here. So what they will think, they will take a buy over here and they will place a stop loss just a little bit below of this candle. Then what price will do, price will go down one more time, sorry, it will go down one more time, and it will take this low, and their stop loss will be taken, and then price will go up. So their analysis was correct, but their stop loss placement was wrong. So that's why the traders, those who are trying to trade smart money concepts, okay, those guys get their stop loss hunt like this. But if you give enough room for the price to breathe, okay, like 10 pips on forex pairs or 15 pips, 20 pips is enough room for price to move around. Okay, it's enough for price to go and do all of his thing, because price can go down one more time to take another liquidity, man. Okay, so just give enough room to it. So now you can see it over here, price went up, took this high over here. Now, as I told you, okay, that what we have to do is we have to just place our buy limits and sell limits where people will place their stop losses. Okay, so people will mark a supply zone over here, right? And there was this type of rejection also. So when people will see this type of bearish engulfing and this doji candle, okay, like this, what they will do when they will see this type of doji candle, they will think that price is about to fall from this supply zone. Okay, so then what we will do is what I told you. What is our strategy? Our strategy is that we will just place our limits where they will place the stop losses. So if they're taking sell from this doji candle, okay, where their stop losses will be little bit above, right, little bit above of this structure, like somewhere right over here. Okay, so then what we'll do is we'll just place our sell limit right over here, and our stop loss will be 20 pips, which will be somewhere around over here. Okay, and now what happened is, like, price goes up, it gives a breakout, right? So now people think that after seeing this type of bullish candle and this type of bullish wick, what to call it, the morning star, no, doji candle, this type of doji candle, okay, when they see this type of doji candle, this type of bullish engulfing, they think that prices gave a breakout. Okay, but we know that's not a breakout, that's a stop loss hunt. Okay, that's a proper stop loss hunt. So price will go up and our limit is over here, so our limit will get triggered over here, and then what happens, price goes down. And now there are some traders, those who will wait for fair value gap, but price didn't came back to this fair value gap right over here. It came back to this fair value gap over here. Okay, but it didn't came back to over here. So that's why I just place my limits. Okay, it's aggressive entry, I know that I'm not waiting for the confirmation, but from this aggressive entry I get sniper entries and I get like little bit good entries. So that's why I use this one. Okay, and now this was the example, and see that what happens after that. Price goes down and takes this low. Okay, price goes down and takes this low, and then it's doing its thing, it's just consolidating. So we made money in the consolidation also. Like, if you see the market is not trending over here, but we know that there's an algorithm, okay, which is based to take liquidity, which is based to search for liquidity. Okay, so price is consolidating, it means like nobody is moving the market right now, like it's not trending, but because of the algorithm still we can get these type of trades. Okay, so I hope you understood this example. So let's go on another example. So this is our another example. You can see these relative equal lows right over here. Okay, you can see these relative equal lows, and what you can see is that this candle is a supply zone. Okay, and price gave a fluctuation from this supply zone once and twice. Okay, so this is a very strong supply zone, okay, for retail traders or the traders, those who trade supply and demand. So like for them this candle is very good supply zone. So now what I told you, that we have to place our limits where they will place their stop losses. So where the stop losses of the traders, those who took the sell from the starting of this candle, like from the starting of this supply zone, they took a sell over here. Okay, like they took a sell over here, and where their stop losses will be just little bit above of this structural high, right? So after this structural high, little bit above, what we'll do is we'll just place our sell limit over here or little bit above of over here. Okay, we place our sell limit and our stop loss will be 10 pips or 15 pips from here. Okay, and what was our target? Our target was these three relative equal lows. So this was the liquidity grab and this was the liquidity run. Okay, when the liquidity grab happens, so market is bearish. Okay, because this what can happen, you can say that there was these relative equal lows and this was the demand zone. So why didn't price went down and went up from here? Why it kept on going down and down and down? It kept on going down and down and down because the overall market is bearish. Okay, the overall market is bearish. So because of that, the buy side liquidity will only work, the sell side liquidity will not work. Sell side liquidity will be taken right now. When market is bearish, the sell side liquidity, the like sell side stop losses will be taken. Okay, it will be not be hunted. Okay, so for example, but the buy side right over here, what happens over here? It's a liquidity grab, right? From a wick, it's a liquidity grab over here. Okay, but this is a liquidity run. So what we have to do is, if market is bearish, we have to look for liquidity grabs. Okay, so over here it was a liquidity grab, So we have to look for liquidity grabs. We have to not look for the liquidity runs, okay? Because we know that where the liquidity run will be in bearish scenario. The liquidity run will be the support, okay? It will be at the support or at the sell side. There will be the liquidity run because market is bearish, so it's seeking for the sell side, okay? But during when the market is bearish and it's seeking buy side and it took the buy side stop losses with a liquidity grab, that's the right entry for sell, okay? That's our entry for sell, so we look for sell over there, okay? So I hope you understood that what is a liquidity grab and what is a liquidity run. Liquidity run is when price goes with the flow, and liquidity grab is when price goes against the flow and makes fool of other traders that market is about to change its character or change the trend. So that's what it is. So I hope you understood this example. Let's go on another example. So this is the another example of NASDAQ. So if you look at over here closely, that it's also the same thing which I showed you in this Euro USD, right? So what happened over here? So there was this candle over here, okay? This candle is what? A demand zone. Why this is a demand zone? For retail traders, not for us. It's a demand zone because market gave a fluctuation from here once, twice, right? But third time it went down of this low, right? And what I told you, that if somebody took a buy from here within the starting of this demand zone, where his stop loss will be? His stop loss will be just a little bit below of this demand zone, right? So what I told you, we have to place our buy limits with the buy limits at the place where they put their stop losses. So we'll place our buy limit right over here, okay? And our stop losses will be 30 points or 40 points in NASDAQ, and our target will be these relative equal highs, like these double tops or like these highs, okay? But price went a little bit really up, but it is what it is, because if you can get 1:2 consistently, go for 1:2 only. Don't go for 1:5 or 1:6, because 1:2 and 1:3 maximum is consistent, okay? It's really consistent. If you can look at it closely, like you can get 1:2 very easily, okay? Or 1:1 also. You can get 1:1 also very easily, okay? But you cannot get 1:8 every time, okay? If somebody would have got that strategy to get 1:2 every time, he would have been a billionaire or something like that, but it's not possible, okay? So let's be realistic. So 1:2 is realistic target, okay? So go for 1:2 and 1:3, and whenever you hit your 1:2, just close your computer. Don't look that where the price is going after that, okay? Because it will make you feel bad that, oh, I missed so much of profit over here. But it is what it is, because there was some news also, so that's why I closed it over here, okay? So these were through relative equal lows. Price went down over here, and then I just placed my buy limit over here, and my stop loss was a little bit below of this. Oh no, my stop loss was really far away. It's not a little bit below, okay? It was like 50 points down over here, and my target was this high, these two double tops. And what happens after that? Price gave a liquidity grab. See, with the wick it gave a liquidity grab, and then it went up and it just took that high, and then it gave us some sort of fluctuation, but this was the liquidity run and this was the liquidity grab. Why? Because the scenario is bullish, like the way I explained in that euro dollar. So this was the bullish run, so liquidity grab happened for the sell side, okay, not for the buy side. For the buy side it was a liquidity run because it's seeking for buy side, because the market scenario is bullish on a high time frame, but it's not looking for sell side, okay? Because market is bullish, so whenever the sell side is taken, that's the perfect spot to entry for us, okay? So over here there was a liquidity grab, it took the sell side, so over here our entry will be, okay? Now let's go on another example. I think so I posted the screenshot of this trade on my Discord group. If you look it over here, 1 second, here, like look over here, I just posted it over here, and this was the TP head, okay? So now look it over here, that these were the two relative equal lows, okay? And this candle over here, this was a really good support, right? So now I can see that this is a really good support, and market is creating that it's going higher, and then it suddenly gave a market structure shift, okay? And then this candle happens and it goes below of these two relative equal lows. So now any trader, those who will see that this type of bearish candle like this, he will be afraid, right? He will think like it will keep on falling and my stop loss will get hit, so he will just leave it. Okay, but we have to play on other people's fear. Okay, because we have to take entry when people get out, right? When they are scared, at that moment we have to take the entry. So that's why we'll just place our limit right over here and our stop loss right over here. Okay, and just let it play, don't touch it. Okay, what worst can happen? You can get a stop loss, or you can get a 1% down, right? Or like a 0.5% down. So like that's not a big deal, like everybody gets a loss. So that's why just place your limit. When people will see this type of candle, there's no single buyer. Like whenever they will see this type of, all the buyers are gone out. The people, those who bought from here, they are from here also, because they thought like this is a supply, this is a demand zone. Like all of them got out over here, their stop losses are hunted, and now all of those traders are like selling over here because they saw this type of big candle towards the downside and a breakout. So they'll think that market will keep on falling, but what happens after that? It goes up and takes this high. So this is a very, very simple strategy which you guys can use, and this strategy needs a proper risk management. So to get a proper risk management on the basis of your capital, you have to practice this strategy for at least 1 or 2 months or 3 months at least. Then only you will get your then only you will get your proper risk management. Okay, so now if you look it over here, it went up and now there is no fair value gap. There can be a fair value gap on 1 minute time frame, it's a 5 minute time frame, but like that's why I don't wait for fair value gap, because I missed the sniper move. Like you can wait, I'm not saying like that's a bad move to wait for, because as a beginner you should wait for it. You should wait for the retracement to the fair value gap, and then you should enter from there and you should target for the buy side. Okay, so I hope you understood this strategy, and it's really simple. Okay, you have to just place your stop loss, you have to just place your buy limits or sell limits where people will place their stop losses. Okay, and you have to look for supply and demands and support and resistance, because then only you will be able to find out the stop losses, and you should target for only 1:2, and you should get a very good risk management. And if you want a very good risk management, then you should look for Mark Douglas books, for example the Trading in the Zone and the Disciplined Trader, and you should listen Dr. David Paul. Okay, from that you can get a good psychology, and you can get a good risk management, and you will get to know about the importance of good risk management from those books. Okay, so I hope you understood. So if you guys have any questions, you can DM me on Instagram, you can DM me on Discord, or you can write down in the comment section below. And if you guys like this video, drop a like and share it with your friends and subscribe for more content like this. So until next time, wish you good luck and be safe.